Hi, welcome to this episode of iFast TV. I'm Colin, Assistant Manager of the Research and Portfolio Management team. And today I'll be sharing our views on Asian equities, and in particular, I'll be sharing the reasons why we remain on board the Asian equity trade. So here are 5 reasons why we remain on board the Asian equity trade, and over the next few slides I'll elaborate in detail each of these reasons. Starting with the first reason, we believe Asia's reopening will be a key driving force. At a country level, international travel has resumed and is steadily picking up for most ASEAN nations, India and South Korea. For regions that have partially or yet to reopen, such as China and Hong Kong, domestic restrictions have also eased significantly as COVID cases decline. And as such, the more economically sensitive parts of these economies have rebounded, potentially lending support to economic momentum in the third quarter as well as the fourth quarter. Economic data validates our view. Take, for example, leading indicators such as the manufacturing PMI shown on the table by the left. PMIs remain above 50 for most Asia's economy and have even rebounded for some countries like the ASEAN nations. And this shows that the manufacturing sector, which are often a major economic driving force for many of the economies in Asia, are still expanding on a month-on-month level. And the other thing I would like to highlight is export growth for the region. And the aggregate export growth is seeing a rebound lately after months of decline, as shown in the chart by the right. The region's reopening as well as China's easing of restrictions have been great in supporting such a bounce. And furthermore, a leading indicator for Asia's export is the Nomura Asia Leading Export Indicator, which has rebounded lately. And this further implies that this rebound may likely be sustained. Another major positive indicator that is reflecting positively is the Citi Economic Surprise Index. This index measures the degree to which economic data is beating or missing estimates. And if the data is positive, it means that data have surprised positively and vice versa. And the larger the value, the larger the positive surprise. And that said, if you look at the APEC data relative to other regions, APEC is the only one with macro data still beating estimates. And this is as denoted by the positive value. And the magnitude of this positive beat has risen in the third quarter, as denoted by the ascending line since the third quarter. And overall, we believe these major macro data points are implying that improving growth momentum is something that is very tangible in Asia and unlike other economic regions as well. So moving on to the next reason, the China factor, which is an integral part of the Asian growth story given its tight equity and economic linkage to Asia. For example, China alone makes up an outsized 36% of the MSCI Asia ex-Japan index, and many companies within the index has a fair degree of revenue exposure to China. As such, an improvement in the China situation can have tremendous positive spillover to Asian equities. And we are positive on the situation in China, as it is increasingly clear that the nation is easing on all fronts. On the fiscal front, policymakers have been stepping up efforts to bolster its economy through targeted policy measures such as tax rebates and the issuance of special bonds. And on the monetary front, the People's Bank of China, PBOC for short, has responded with easing measures such as policy rate cuts. And more recently on the COVID front, China has also been calibrating and softening its COVID-19 restrictions. Policymakers have moved subtly from a strict approach that pursues zero infections to what they now call a dynamic zero, which is a less restrictive approach that aims to contain outbreaks in the shortest time possible. So all things considered, we see clear signs that Chinese policymakers are now more focused on growth stabilization than before. And an improvement in the current situation should have positive spillover to the region, thereby driving the equity performance. Moving on to the third reason, we now see less downside risk from earnings disappointment in Asia. The earnings downgrade cycle for Asian equities has started in February this year, and consensus EPS for the region has been revised down by about 10% in the year to date. So that has fueled a wave of negative price reaction. And on the contrary, earnings estimates for developed markets remain largely optimistic. For example, in the US, consensus estimates are generally positive throughout the year, with earnings downgrade only starting in the current quarter. For Europe's case, the region is still seeing earnings upgrades, and despite a deteriorating macro as well as a policy backdrop. So broadly, we believe that the consensus are pessimistic on Asia's earnings and overly optimistic on DM equity earnings. And already we are seeing a string of better than expected earnings result in the second quarter, including the likes of TSMC, JD or Alibaba. And this is in contrast with a number of high-profile earnings misses from DM companies such as Microsoft, Alphabet, Meta and Nestle. So this is significant as we now see a higher risk for earnings disappointment for DM equities, and that implies a larger risk of negative price reactions. However, for Asia, this risk is now much lesser, with consensus expectations arguably lower, and as I'll later show, the downgrade cycle is likely halfway through. So reason 4 is that we now see a temporary earnings weakness, but we believe that the long-term outlook remains well supported. We expect earnings for Asian equities to grow 2 to 4% for FY 2022 to FY 2023 before a 12% rebound in FY 2024. Earnings growth will likely face some challenges in the near term coming from the tech and communication services companies. So this is due to a combination of reasons, namely the down cycle for chip makers as well as a destocking trend in hardware companies where many are clearing their elevated levels of inventory right now. And lastly, a profit headwinds for many of the internet companies in China due to the softening demand as well as recent regulatory changes. However, we believe that this weakness is likely temporal as firstly, the semiconductor down cycle as well as the tech destocking trends are cyclical in nature, which like every other cycle, it comes and goes. And also, the regulatory headwinds in China are subsiding, and as I've highlighted earlier, more growth support are incoming. So more broadly, we are also continuing to observe a growing leadership in Asia's tech company beyond the conventional semiconductor industry and in fast-growing areas such as your 5G, automation, electronic vehicles, as well as the e-commerce sector. So these are industries that present many secular opportunities, and Asia's growing leadership in these areas help paint a comforting as well as a positive long-term view. I would also like to point out that there are signs that the earnings weakness is temporal when comparing against historical EPS downgrade. And as I've highlighted earlier, Asian equities are currently caught in the EPS downgrade cycle, its sixth cycle over the past 20 years. So this cycle is currently about 7 months old and EPS has been revised down by about 10%. So comparatively, each of the past 5 cycles lasted an average of about 10 months with an EPS downgrade of around 22%. And this is important because by comparing the duration of a typical EPS downgrade cycle, the current one is implied to be more than halfway through the cycle. And by comparing the magnitude of the downgrade, the current one is implied to be roughly halfway through the cycle as well. So all these observations do match up and in fact suggest that Asian equities may be midway through its EPS downgrade cycle. So if the current cycle moves closely with history, this will imply that further downgrades, while possible, might not be overly severe or lengthy. Moving on to the final reason, which is compelling valuations. And in terms of the forward PE ratio for Asian equities, it has derated significantly in the year to date by almost 1 standard deviation relative to its historical mean. And as shown on this chart right here, despite the hefty earnings downgrade, valuations have crashed, bringing multiples back to levels not seen since the COVID-19 trough, as well as the trade war times and the periodic lows between 2011 to 2016. And you can clearly see this in a chart from the circled areas. And right now, we find that valuations are compelling as the forward PE ratio is now trading at an attractive discount of more than 12% relative to its long-term average. And also on a more granular level, valuations are not only trading at a discount but also closer to the historical lows for many of the sectors. There are 7 out of the 11 sectors, as shown on this chart right here, which are trading at this kind of levels. And for sectors that trade at a premium, such as your consumer discretionary, your communication services, healthcare or utility sectors, we find that it is largely due to significant large earnings downgrade rather than a surge in equity prices. So with valuation levels for both on an index level as well as a sectorial level near historical lows, we think that the current levels are indeed attractive and may in fact imply that lesser equity downside if sentiments deteriorate further. So once again, before I end, here are the 5 reasons why we remain on board the Asian equity trade. And looking forward, we project a target price of about 920 for the MSCI Asia ex-Japan Index by end 2024, which implies an attractive 48% maximum upside potential. And in summary, we expect some near-term headwinds for Asia equities, but beyond that, we believe that the risk-reward for Asian equities has improved, especially after the sell-off. Alright, with that, I conclude this presentation on our outlook for Asian equities. I hope the viewers have some valuable takeaway from today's sharing, and thank you for your time.